Today, we will literally fly under Wall Street's radar and analyze one of the top secret stocks called Northrop Grumman. As we are currently in a defense and tech revival phase in the market, we are seeing one major trend, the hype around drone and upcoming military tech stocks, leading to insane valuations comparable to the dot-com era, with companies making millions while being valued at billions. While drone stocks are all over the place and small upcoming defense companies aim to disrupt the military sector, this stock is different. It's like a dinosaur, like a huge tanker, and one to put on your watch list. To describe Northrop Grumman best, here are their latest and most prominent products: the center fuselage of the F-35 Lightning II, the B-2 Spirit stealth bomber, and of course the new B-21 radar strategic stealth bomber. Besides aeronautical systems, they are also active in defensive systems, such as strategical and tactical missiles, mission systems like radar or C4ISR, which stands for Command Control Communication Computers, Intelligence, Surveillance, and Reconnaissance. Lastly, they are developing parts for space systems such as satellites. Just to give you a sense of how much their airplanes cost, the F-35 Lightning II sits at around $82 million, but here Northrop Grumman mainly produces the center fuselage. A single B-2 Spirit had a price tag of $1.157 billion in 1998, which with inflation would be equal to about $2.34 billion today. Finally, the B-21 radar is notably cheaper at $692 million in 2022 and worth about $772 million today. All of these planes are made for strategic stealth operations, so while speed is important, it is even more important to be invisible on radar. Why does this stock fly under Wall Street's radar, and are they over or undervalued? Let's compare this dinosaur with some upcoming trendy military stocks. AeroVironment, Drone Shield, and Kratos Defense are each worth billions, having valuations that are hard to justify for long-term defensive investors. Taking a closer look at AeroVironment's last 2 quarters, we see a negative earnings per share, resulting in a PE ratio of 0 or undefined. The same applies to Australian-based Drone Shield. Kratos Defense earned just 13 cents per share, while one share currently costs a lofty $87, resulting in an astronomical high PE ratio of 669. Compared with this, Northrop Grumman is in a different league. Over the last 4 quarters, they earned $29.08 per share, with one share currently priced at $733, resulting in a PE ratio of 25.12. Of course, these new upcoming players aren't the direct mature competition for Northrop Grumman. In their 10K forum, they identified RTX Corporation, Lockheed Martin, L3Harris, Boeing, and General Dynamics as their main competitors. Except for General Dynamics, all of them are trading at a higher PE ratio. As General Dynamics focuses more on marine systems, they only have overlapping categories, such as sensors and the C4ISR sector. Both stocks are above their 10-year median PE ratio, with General Dynamics about 17% above and Northrop Grumman about 24% above. This indicates a slight overvaluation in both cases. Therefore, we recommend following these companies closely and setting price targets of about $292 per share of General Dynamics and $558 for Northrop Grumman to match their 10-year median PE ratios, if and only if their earnings per share do not drop. Additionally, it is important to mention that the US government is their main customer. Key risks therefore include political dependency, potential breaches of the debt ceiling, and future budget decisions, as they are also disclosed in their 10K form. However, this is normal for the companies operating in this sector. We believe that even at current valuations, Northrop Grumman is still fairly valued. As the company produces indispensable stealth products, we think they are definitely flying a bit under Wall Street's radar compared to their competitors' valuations. Thanks for watching and keep investing.